Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 393 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today we are going to be talking about buckets, and specifically retiring via the retirement bucket strategy. And if you don't know what this is, or you don't know what this looks like, then just hold on. We are going to get to every single bit of it. But I want to talk about this specific retirement allocation strategy and this way that you can set up your retirement funds to take proper risk, to make returns that you still need to make in retirement, and be able to get the money that you need from your retirement portfolio. So hopefully this episode is helpful for you and helps you to think about another situation, another option when it comes to how you are going to live on the money that you have when you ultimately retire. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, a couple weeks ago, I did an episode on this show called Don't Outlive Your Money. And I think that was a pretty good episode. And I talked a lot about retiring and making sure that you had the money that you needed and that you did all the things that you were supposed to do. And I alluded to the bucket approach, right? I alluded to buckets for the retirement allocation. Now, since then, I've done a little more digging into this approach because I hadn't learned too much about it. I hadn't dealt with it too much. But as I dug in more and more, I found that this is a very interesting approach to being able to live on the money that you have in retirement, right? Because I think one of the biggest concerns that people have in their financial lives is, okay, well, when I retire, do I have enough, right? Am I going to be able to live on what I have? And then if so, how long? Am I going to outlive it at any point? And I think the bucket approach does a good job of managing risk, managing where you are in your portfolio while still providing you the liquid cash that you need and the growth that you need from your portfolio. So I'm just going to break down for you exactly what this approach is and then talk about how it performed in 2021, because I think that'd be relevant and helpful for you guys when it comes to understanding what this is. And if you're somebody who's already in retirement, then you can definitely adopt this type of approach. You can talk to a financial advisor about helping you with setting up such an approach. Or if you're like myself and you're nowhere near retirement, or maybe you are near retirement, you're just not there yet, you can think about this as a potential approach for you or you and your spouse as you move towards those golden years. So the bucket approach to retirement portfolio management, which was pioneered by financial planning guru Harold Ivinsky, aims to meet the challenges that effectively help retirees to create a paycheck from their investment assets. Whereas some retirees have stuck with an income-centric approach, but have been forced into even riskier securities over time, the bucket concept is anchored on the basic premise that assets needed to fund near-term living expenses ought to remain in cash, dinky yields and all. Assets that won't be needed for several years can be parked in a diversified pool of long-term holdings, with a cash buffer providing the peace of mind to ride out periodic downturns in the long-term portfolio. So again, here we are diversifying, we're making sure that we're taking the proper risk, and yet we're still getting returns. And something that's alluded to is that many people still take an income-centric approach, right? They still think that they have to have income-producing assets. And that's not true, right? You don't have to have an asset that provides you income per se in order to have the income that you need. You just need assets that grow and compound over time at a reasonable rate. Not to mention, a good dividend is harder to come by than it used to be. And bonds that pay good coupon rates are harder to come by than they used to be. So such an approach may be more and more suitable for retirees of this time in history. Now, let's talk about the buckets. Okay. Now, this bucket approach is 3 different buckets. Okay. And I guess it could be more based on how granular you want to get with these topics. But in general, we want to think of this as 3 buckets. Okay. So we'll start with the first. Right. The linchpin of any bucket framework is a highly liquid component to meet near-term living expenses for 1 year or more. Cash yields are extremely low, so bucket 1 is by no means a return engine. But the goal of this portfolio sleeve is to establish stabilize principal to meet some income needs not covered by other income sources. To arrive at the amount of money to hold in bucket 1, what you need to do is start by sketching out spending needs on an annual basis. Subtract from that amount any certain non-portfolio sources of income, such as Social Security, pension payments, whatever. And the amount left over is the starting point for bucket 1. That's the amount of annual income bucket 1 will need to supply. So you need to determine how much income you're going to need in your first year of retirement, and then take out any Social Security or pension payments that are going to be recurring and continuing over a long period of time, right? And then that will be your starting point. Now, more conservative investors will want to multiply that figure by 2 to determine their cash holdings, right? They'll want 2 years worth of cash, and then some want even more. But many, 1 to 2 years. I don't think there's any reason to go above that, because then you start to sacrifice your ability to build in some of the other buckets. Now, alternatively, investors concerned about the opportunity cost of so much cash might consider building a 2-part liquidity pool: 1 year of living expenses in true cash and 1 more year in a slightly higher yielding alternative holding, such as a short-term bond fund. Now, a retiree might also consider including an emergency fund within bucket 1 to defray unanticipated expenses such as car repairs, additional healthcare costs, and so on. And I would suggest that to be the case, right? You should still have an emergency fund. Like if you're going to go retire right now, you should already have an emergency fund while you're working, right? So you should have that emergency fund and your nest egg, your portfolio to go along with that emergency fund. So I think that is very astute. So very simply, bucket 1 is cash, right? Bucket 1 is going to meet your needs early on in retirement. It's going to be money that you live on all through retirement, right? You will only pull money to live on from bucket 1, okay? Now, bucket 1 can also be tempting, okay? And this is a weird way to think about it, but it's very true. So many people have a problem with if they get large amounts of money in one account at one period of time, then they may just go and spend all of that account. Now, that can be easily reconciled, right? What you can do is you can have bucket 1 within your IRA, your 401k, your taxable brokerage account, whatever, right? And you can have it in a money market fund or whatever, and just have it pay you like a paycheck every 2 weeks or every month or whatever. So your checking or savings account don't get too overblown to the point where you're like, ooh, I got all this money, I can just spend it. And then you spend out your year's worth of income far quicker than you thought that you ultimately would. But this first bucket is extremely important because it's going to allow you to meet your short-term needs while the rest of your money has different things going, okay? Which brings me to bucket 2 and beyond, okay? Now, although retirees may customize different frameworks for the number of buckets they hold, right? I said this, you can have many different buckets, but I think 3 buckets can be perfectly fine, right? And they can also change the type of assets that each type of bucket has, right? I think that 3 buckets will be proper. So bucket 2 is this portfolio segment that contains 5 or more years worth of living expenses. And the goal here is to produce income and stability. Okay, so you're going to have 5 or more, so at least 5 years worth of living expenses here, and you're going to have it with the goal of producing income. Okay, and the whole point, if you don't know by now, of this bucket idea is that we know that bucket one will eventually run out. And so we want to replenish bucket one with the other buckets. Okay. But not all of our other buckets need to be, just super long-term view, because the idea here is that assets such as stocks that are more volatile, they are going to need more time to guarantee positive returns, right? And so the longer term you are going to need something, then you can put that money in stocks. But the shorter term, you're going to take less and less risk the more urgently you need the money. So thus, this second bucket is dominated by high quality fixed income exposure, though it might also include high quality dividend paying equities and other yield rich securities such as mastered limited partnerships, which pay quite large dividend yields. Now, balanced or conservative and moderate allocation funds would also be appropriate in this part of the portfolio. So have some stocks and bonds and be able to produce some income, right? Income distributions from this portion of the portfolio can be used to refill bucket one as those assets are depleted. Why not simply spend the income proceeds directly and skip bucket one altogether, you may ask? Well, because most retirees desire a reasonably consistent income stream to help keep their income needs taken care of. If yields are low, the retiree can maintain a constant standard of living by looking to other portfolio sources, such as rebalancing proceeds from buckets 2 and 3 to refill bucket 1, right? So ultimately, you're going to live out of bucket 1. And then bucket 2 is going to be creating income to the point where you can refill bucket 1 as need be, right? And I mean, you may also have to reach into bucket 3 in order to refill bucket 1. I would suggest that you probably will, depending on the size of your portfolio. But ultimately, the idea is that buckets 2 and 3 will keep bucket 1 filled. Bucket 2 is probably not going to have a ton of growth over time that's going to compound in there, because you're going to be taking the income and pouring it back into bucket 1. But hopefully bucket 3 provides you with the growth that you need. And so we'll get to bucket 3 here. Bucket 3 is the longest term portion of the portfolio. It's dominated by stocks and more volatile bonds such as junk bonds. Because this portion of the portfolio is likely to deliver the best long-term performance, it will require periodic trimming to help the total portfolio from becoming too equity heavy. By the same token, this portion of the portfolio will also have much greater loss potential than buckets 1 and 2. Those portfolio components are in a place to prevent the investor from tapping bucket 3 when it's in a slump, which would otherwise turn paper losses into real ones. Okay? So bucket 3 is going to be your more volatile assets. It's going to be your assets that are more likely to grow over long periods of time. It's going to be where you hold the vast majority of your stocks, growth stocks, S&P 500, different types of things like that, right? Now, you may also hold some bonds, but those bonds should be a little more to the risky side. That way, they may have better long-term performance relative to the bonds that are held in maybe bucket 2. Now, how do you maintain these buckets? How is this supposed to look in your financial life, investment life? How are you supposed to make sure that you have what you need? Well, this bucket structure calls for adding assets back to bucket 1 as the cash is spent down. Yet, investors can exercise a lot of leeway to determine the logistics of that necessary bucket maintenance, right? The following sequence will make sense in many situations. So, income from cash holdings in bucket 1, right? So you take your income from the cash in bucket 1. Then income from bonds and dividend paying stocks from buckets 2 and possibly even 3, right? If you have some income producing assets in bucket 3, which for sure you'll have some that produce some dividends, right? You'll take those, right? You'll take that income, and then you'll rebalance the proceeds from buckets 2 and especially buckets 3, right? You'll rebalance those and then put money into bucket 1. Then you'll take principal withdrawals from bucket 2, provided that you have taken all that income and it's not enough, right? So let's say that you have the income in bucket 1, you spend it, and you have income coming from bucket 2 and you spend it as well. And then now you're looking like, okay, well, I need to take some more money. Well, then you would dig into the principal from bucket two. But even then, we would reallocate money back into bucket two over time. So such a scenario would tend to be most likely in a 2008 style environment when bond and dividend yields drop and equities slump, thereby making it an inopportune time to unload equities. Such a scenario would generally be a decent time to engage in tax loss selling, but the proceeds of that would be best deployed back into equities. So ultimately what we're going to do is we're going to live on bucket one. Bucket two will replenish bucket one. Remember, that's 5 years at least worth of income in bucket two. So let's say you've got 5 years worth of income and you can somehow swing returns from bucket two, let's say of 4.5%, right? Because these are income producing assets. They're not super volatile. I think that's fair enough. So let's say that in bucket two, you have 5 years worth of expenses. So let's just start with this. Let's say that $75,000 is what you need to live on. Okay. And that's what you need to live on, year by year. We'll just use a static number, even though that's not realistic. And then you need 5 years worth of that in bucket two. That means in bucket two, you need to have $375,000. Okay. So just right there, you've got a $450,000 nest egg that you must have. Now everything else goes into bucket three. Now let's just say you've got $1 million portfolio. So if you have $1 million portfolio and you take out those other two values in bucket one and bucket two, then bucket three will have $550,000 in that bucket. Now, if I can make 4.5%, right, on bucket two, that's going to be $16,875 per year, okay, which is fine. That'll work out perfectly fine. But let's say that also in our bucket three, let's say we're making 8% a year in bucket three. Well, that means that we're going to have that $16,875 plus $44,000. So we'll have $60,875 a year that we can push back into bucket one. So will we have to dig into principal over time? Sure, you will, but this amount of money will last you quite a while. So ultimately, we're saying that of the million, that we're making a little over 6% a year on the million, right? So we're saying that $60,875 is what you end up making. So I'm going to run the math out here, right? And see how long your money will last in this particular situation. Because you can run this just like a portfolio that's creating income, that's just creating income systematically for you over time. So we're going to take this $1 million, we're going to take out $75,000 a year, and then we're going to grow the portfolio at 1 plus that 6.0875% rate of return, right? And then the question is, how long will such a portfolio last you? Let's see, such a portfolio should last you 25 years in retirement. So this is not the ideal portfolio, but this is saying you took out $75,000 above and beyond Social Security and pension. The hope is that over time that you would have plenty, right? That you would have plenty of money to continue growing for yourself. Now, the beauty of the buckets is that the more money you have, the more useful the buckets are going to be. So for instance, let's say instead of $1 million portfolio here, that you still needed $75,000 a year, but instead of $1 million portfolio, you had a $2 million portfolio. So that turns bucket three from $550,000 to $1,550,000, right? So what does that do? That makes the annual growth of that bucket three $124,000. So bucket three by itself is creating the income that you need over time, right? And so then you take your $2 million portfolio, and that portfolio is going to grow at a pretty constant clip over time because you're making, on an annual basis, you're making over 7% on that $2 million portfolio. Now, if you were making 7% on, let's say, a $1 million portfolio, then you're still going backwards over time because you need 7.5% to keep up with the $75,000 a year distributions, right? So this is just stuff that you have to work out, things that you have to figure out. But the bigger your portfolio is, the easier this is going to be. But we just have to think of it this way: income from one, then the money from two, right? The income from bucket two can get pushed on to one. right? Along with any principal that you need from bucket 2 to replenish bucket 1. And then you take whatever growth from bucket 3 and replenish bucket 2, right? So over time, this is a really good strategy as long as you have adequate funds. This does not take away the need to have adequate funds in your portfolio. Of course, you need to have a retirement account that's big enough to create the income for you that it can, because ultimately here, we're taking large amounts of money and setting it aside in cash or setting it aside in lower yielding assets. And in doing so, that means you have to have a larger portfolio. But what this is allowing us to do is to spread our risk better, right? And be able to still have long-term growth portions of our portfolio, but have our short-term needs taken care of without having to worry about large market swings in the short term. Because that's some of our biggest concerns when we're going into retirement is, will the market drop? Well, you don't care if what you need in the next year or even the next 5 is in, more liquid assets, right? And assets that are not going to be as volatile, and assets that are going to provide you with the income that you need quite reliably, okay? So that's the bucket approach. Now, what has been the performance of the bucket approach in 2021, right? Well, let's just take a view of the bucket approach and how it has performed. Somebody went through and did this based on, different, mutual funds that you may hold that could, help to, create this bucket approach. But these aren't necessarily the mutual funds I would choose, so I'm not going to go through all of them. But they basically did an aggressive bucket, a moderate bucket portfolio, and then a conservative bucket portfolio. And I think this would obviously have to do with how much short-term cash that they hold, how much they're going to have invested in the higher yielding assets over time, and then ultimately what that's going to help them to do with their portfolio based on whatever risk tolerance you are comfortable with. So the aggressive bucket held 8% cash, 8% short-term bonds or short-term cash. It held 10% in a harbor bond fund, 7% in short-term inflation protected securities, 10% in a balanced fund, 10% in a total stock market index, 24% in a dividend appreciation index, 15% in international growth and income fund, and then 8% in a Loomis sales bond fund, okay? So ultimately, that 2021 return for that aggressive portfolio was 11.06%. And if you just take that and you compare that to the S&P 500 over the course of 2021, so we'll just go, let's see, I'm going to just do some quick math here and say from December 31st, 2020 to December 31st, 2021, S&P 500 was up 26.89%, right? So we don't expect to keep up with the S&P 500, but the volatility was far, far less in such a portfolio. Even the aggressive bucket portfolio, very much lower volatility. Then in the moderate bucket portfolio, there was 10% cash, 10% short-term bonds, so higher allocations there, 5% floating rate high income, 15% in the harbor bond fund, okay, so that's 5% more than the aggressive portfolio. 10% in short-term inflation protected securities, which is more than the aggressive portfolio. 5% in a balanced fund, which is less than the aggressive. 10% in total stock market index, which is the same. 20% in the dividend appreciation index, which is 4% less than the aggressive. 10% in international growth and income, which is 5% less than the aggressive, and then 5% in the Loomis sales bond fund, right? And the 2021 return there is 9.49%, right? So you took less risk and you got a lower return associated with it. Then there's the conservative bucket approach, right? And this, again, is going to have more cash, more short-term, right? So 12% cash, 12% short-term bond, 5% floating rate high income, 20% harbor bond fund, 11% in inflation-protected securities, 5% balanced fund, 23% dividend appreciation index, 7% international growth and income, and then 5% in the Loomis sales bond fund. And this would have had a 7.35% return in 2021. Now, several of the same performance trends that prevailed in 2020 carried into 2021, namely U.S. equities reigned supreme. Reprising its status from 2019 and 2020, the total stock market index was the top performing holding among the portfolios, which gained 26%. The core equity holding, the dividend appreciation index, trailed the total market index by a few percentage points. And the main drawback for the dividend growth focused index was the underweight in technology stocks. It holds just 16% in that sector. Then the dividend appreciation index also suffered for its lack of energy holdings in a year which energy mounted a strong recovery. But this is a fund that can create income and growth for the investor. Now, bond performance flip-flopped in 2021 from the prior year, whereas high-quality bonds carried the day in 2020. Thanks to the Federal Reserve's aggressive lowering of interest rates in the onset of the pandemic, they struggled in 2021 as the Fed signaled it would lift rates this year. But it's not necessary to make large changes in the portfolio year to year. You are going to have to rebalance. You are going to make sure that you have the proper risk asset allocation set up, and then you can work your way through the year. But I would suggest with this buckets approach that on a yearly basis, you're going to need to do some type of rebalancing. Make sure that you have the proper risk taking going on and that your portfolio buckets are doing what you need them to do. Now, do I suggest this for everyone? No, I don't, right? This is going to be most useful for those who have adequate retirement savings, who just need a proper way to allocate their money and make sure that they get what they need and don't take too much risk, right? I do think that this is helpful, whether you do the aggressive or the conservative, whatever. It's helpful in choosing a moderate amount of risk to take in retirement, because I think it's so difficult for a lot of risk-taking individuals when it comes to investing, like myself, to say, how do I take risk off? This can be helpful even among the aggressive portfolio, right? But even for those who have, a more conservative mindset, they can still have proper allocations into stocks and, dividend producing equities and things like that. So I think that this is a very good choice for those that do have adequate retirement savings. Now, of course, if you have a huge retirement nest egg, you have a huge amount of money to retire on, this is not necessarily going to be useful, right? Because let's just say hypothetically, right? Let's say you had $10 million, right? And name a number, right? Let's say you needed $200,000 a year off of that 10 million, then what? That's 2% a year that you're going to have to create in income. Hypothetically, you could just leave that 10 million all in stocks if you wanted to, or all in cash if you wanted to, whatever you wanted to do with it. You could likely get away with it for some time, because even if that were all in cash, that's going to create 50 years worth of $200,000 a year, right? So that's pretty substantial. So it's not a big deal when you have a very, very large portfolio. And if you have a very small portfolio, then this is not going to be useful for you, because people with smaller portfolios have to take more risk. But you know that I will push you to stay working, build your portfolio up enough to where you can take the proper risk in retirement and not overdo it, because I've seen people overdo it and they get very uncomfortable with their investment allocations, and that is not a good place to be in retirement. And then they end up selling at the bottom and probably freaking out during these market downturns. It's just not a good thing. But overall, I think the buckets approach is a good approach to take. If it's something that you're interested in, I can help you talk through it, walk through it, and hopefully it's something that you can add to your repertoire and something that you can use to think about as you move into this next year of investing. And if you are retired, maybe you take this to heart and think that this is something that could be useful for you. If you're moving towards the retirement years, maybe you keep this in the back of your mind. And when your financial advisor suggests something, maybe you suggest this and say, hey, can we do this? Can we put this together? And can you help me to do so? So I think this is useful, and I hope that you guys at least glean from this the possibility of being able to spread your risk out, have proper asset allocation, and still be able to meet your needs of both growth and income in the short term in retirement. So thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.